Hello, everyone, and welcome to our next edition of the Fireside Chat with Prentice Wealth Management. My name is Jim Niddle, and I'll be your facilitator for today. I'm really excited. We've got a short but great session here. I'm here with Bill Prentice and Shawn Tesoro of Prentice Wealth Management, and our focus here today is talking about what's going on in the marketplace. So, Bill, Shawn, good to see you guys. How have you been?
Great, Jim. How are you?
Great.
Good,
Thanks for
thanks.
coming, Jim.
Thank you. Well, I appreciate the opportunity to be here. Let's dive right in. So, I know the Federal Reserve has begun its interest rate cutting process. How are you guys viewing this first round, and what are your thoughts moving forward with regard to how often they'll be cutting? What is the cadence behind that? And how much accommodation in terms of aggregate depth of cuts is likely to be provided in the coming year?
Yeah, we'll start there, Jim. The Fed last week on Wednesday cut by 50 basis points. The front part of September through the middle part of the month, there had been a building consensus that 50 was on the table, and they met expectations for the most part. The reason that they're cutting now is that they feel like while they haven't arrested inflation, they feel very comfortable with the direction and the moderation that we're seeing in inflation statistics. And their focus now is shifting to the other part of their dual mandate, which is inflation and prices, and then the other side is employment. And the goal is to now shore up the employment situation as much as they can. We've had an uptick in employment for, call it, a half a percentage point or so from earlier in the year. And I think their goal now is, or their hope is, that they can kind of keep that employment in the 4.5% to 5% range, given the solid but slowing economy. So it was their first kind of opening salvo here. There's more to come based on kind of what they indicated to us. There's probably another 75 basis points of cuts through the rest of this year, 2024, another 75 to 100 basis points scheduled for 2025, and then a little bit more in 2026. And the one caveat point I'll say there is the market, or the yield markets, are a little bit ahead of that pace. So it's going to be interesting to see how the Fed kind of wrestles with that and brings that together. So that's pretty much what the Fed did last Wednesday and what their outlook is going forward.
Yeah, thank you, Shawn. I appreciate that. It's a great overview. Bill, I'm wondering if you've got any thoughts, anything you would add there.
Yeah, thanks, Jim. I was a little shocked. I think people have, if they've been tuning in, it was always in my mind that we were going to get 25 basis points or 0.25% reduction. And it materialized in 50 basis points, which is a half a percent, as Shawn said. So, it's a positive surprise. I think the number is far less important than the trajectory. I think in many ways the Fed wanted to make a statement that they are ready, willing, and extremely able to react quickly, perhaps before data, which is unique. We don't have declining economic data in a traditional sense. People have probably heard me rail for years on data is history, right? It's reporting history, and you can't prevent something by driving in the rearview mirror. And I think that's part of this message that the Fed's sending is we're not going to wait for things to deteriorate. We're going to start to react in anticipation of deterioration. And, they may be really right. They may be wrong. We're going to find out. And I think that in many ways, I tip my cap to them that they're willing to take that risk. It's not a risk that we see commonly, that they are stepping into the fire, so to speak. Because if you react, and this is what I mean, if you react based on data, it's hard for somebody to say that you were reacting inappropriately if the data is deteriorating. So this puts them into a riskier position in terms of, potentially being held accountable, politically, if we can use that term, even though they're supposed to not be a politically, centric body. They're not elected officials. So I think a tip of the hat to them that they're willing to step in and try to execute a soft landing, because they do have to react in advance to execute a soft landing.
Yeah. That makes a lot of sense, Bill. And again, thank you for the update. I want to dig a little deeper into that, though. So, from both of your perspectives, what does this mean for financial markets? And let's start, Shawn, on the equity side.
Yeah, so I think given the situation where we're in a solid but slowing economy, the rate cuts are actually probably more of a positive in the near term. And again, they're data dependent on how much they cut and whatnot. But they do have some sort of flexibility given that they're about 50 to 100 basis points among where they normally be when they start a rate cutting cycle. You could argue, and some people would say that they've been a little more overly restrictive. But I think from an equities perspective, it puts a lot of different areas in play. So we'll start with utilities. Historically, utilities are known for growing in kind of the mid single digit range and then paying a decent dividend. With the higher Fed funds rate up in the 5.25% to 5.5% rate, there hasn't been that traditional gap of what we see from a strong utility paying 4.5% dividend versus the Fed funds rate. Now with rates coming in, we're going to see some of that, and we've seen utilities respond relatively favorably based on that move. They had underperformed the front part of the year, but they've been very good performers of late. You can say the same for real estate, which is similar to utilities in terms of the dividend payout component, but also the real estate ties more into the broader economy as a whole. And then consumer staples would be another area that historically you would see benefit. Staples, it's going to be a little trickier because we know from inflation and hearing it from folks that folks are stretched in terms of what they've been paying at the supermarket and other expenses and whatnot. So even though commodity prices have come in, and historically that's been a positive for expanding margins for consumer staple companies, I think we are seeing some issues on the volume side that just don't have us as favorable about consumer staples as we are with respect to utilities and real estate. So I'll stop there and push it to Bill, and then we can come back to equities if we want.
Yeah, in terms of execution, I think there are a few things that utilities are one where in our separately managed accounts, which are individual positions, the expression has been moving longer in terms of maturity, and I'll get into this structurally here briefly, but we're taking on what's referred to as duration, which is essentially longer maturities. It's interest rate risk, essentially, sensitivity to interest rate risk. That cuts both ways. Rates go up, you lose a fair amount of money. Rates go down, you can, not always, but you can make a fair amount of money. So the structure generally been looking for are 4% or lower coupons, 5% or higher maturity. And that basically, in simple terms, means that the bond is trading below par value. And there's really a secondary reason we're looking for, we're shopping the market regularly for this structure. Those bonds are unlikely to be called. We're likely going into a relatively lower for, I won't say longer, but we will be in a cycle of low rates as we try to combat any recessionary tones. And so we don't want the bonds to be called away, right? You can buy essentially the same. Oftentimes you can buy the same type of bond from the same issuer. One's got a higher coupon. And so think about it like refinancing your mortgage. If you have a 6% mortgage right now, you're waiting for rates to go down so you can get rid of that mortgage and refinance down to 5. Companies are doing the same thing. But if you have a 3% mortgage, you don't want to get rid of that. People are going to stay in their homes longer because they have a low mortgage. We're seeing some of that evidence. And the same is true for the bond market. They're not going to call back or force the repurchase of a bond that's at, say sub 4% right now, unless new money rates are below 4%. It's a very logical outcome. So we can lock in a relatively good return over a long period of time in differentiating the rate and term structures of the bonds. And so we've been pretty active in that for a few months. And again, it wasn't important necessarily that the Fed reduced by 50 basis points. It was important that the markets and the Fed were clearly telegraphing a cycle of rate reductions. If they reduce by 1%, that's terrific. We should benefit from that. If they reduce by 150 basis points or 1.5%, we should benefit from that a little bit more. It wasn't necessary. The end point is less concerning than the trajectory and the likelihood of 100 basis points or 1% coming off of the price of short-term bonds. Secondarily to that, and I'm going to monopolize this for just a minute, the rate structure, short to long, has been inverted. In other words, long interest rates have been lower than short-term interest rates for quite a while. It's now flattening and tilting to a more normal structure. which is shorter term rates are going to be lower. And as the Fed continues to lower rates on the short run, on the short end, which is where they're affecting change, this should continue to change. In other words, it should continue to change the slope of rates, where short-term rates, so think bank cash, are going to go down in terms of rates being paid, and long-term rates will either anchor at around where they are now, 4.25%, or potentially go down slightly, but not nearly as much as the short-term rates, because that's where the Fed is putting their weight, and they're moving that down. And the rest of the curve should come under a normal risk-taking paradigm. In other words, if I lend money to you, Jim, and it's for 30 days, I might charge you 3% annualized. But if I lend money to you for 30, there's no way I'm charging you 3%. I mean, most people, if you put that question to them very simply, they understand that over 30 years, I can't predict your life, future, and finances. I need more premium in terms of interest rate to take on that risk. And so we're going back to a more logical structure based on the Federal Reserve normalizing.
All makes perfect sense. So thank you for that overview, first and foremost. One of the things I'm interested in as we look towards the end of the year, we're getting at the end of Q3 right now. How are we positioned from an investment perspective to either take advantage of market opportunities or to protect against significant downside moves?
I'll start with that. I'll speak on the equity side. Valuations are elevated. There's no doubt about that. You're going to get arguments or debates around how elevated they are, but they're elevated from a historical perspective. That's going to give us the opportunity where we feel like, and I'm starting to see it on certain parts of our portfolios where, there's not a lot of upside in we have a risk reward for every one of our individual positions, and you're not seeing as much upside. But the downside's anchored, so there's an opportunity maybe in a sell-off that you're going to disproportionately sell off in that specific stock. We're going to start to book some of those gains and look for areas and we're starting to see it from a rotation perspective, areas that have not participated like tech and communication services and some of the industrials. So think more like utilities and real estate we had talked about earlier, somewhat consumer discretionary, where you may have opportunity where on a risk-reward basis, they show a little more reward potential and slightly less risk than some areas of tech or whatnot that have performed incredibly well over the last 3 or 4 years and have really benefited from the environment we've been in. But as we kind of widen out right now, and I think this is incredibly healthy for markets. It doesn't mean we go 10 or 15% higher between now and year end. It may be that we just hold in or we gain a few percent from here, but it allows the market to have different sectors that are leading it, which is always a positive versus having those 1 or 2 sectors, Jim, that just continually do the heavy lifting and they get really extended in their big weights within the respective indexes. Then when they sell off, the market takes a pretty big digger. That's what we're trying to avoid. I think we've done a relatively good job of that now, but I'm starting to see it in some areas that are maybe not tech where the stocks have performed very well. And it probably makes sense for us to kind of either trim the position, pair the position, or outright sell the position and try to find something else that maybe hasn't been as bountiful and has the opportunity. It still has to have good fundamentals. It still has to be well positioned in its respective industry or space. And it still has to have good management team that's going to be able to kind of operate in this challenging environment we have. But from our perspective, that's what we're looking to. The other point I'll say in our asset allocation portfolios is, the need to rebalance or the need to kind of make sure that one side of the equation, equity on one side, fixed income on the other, doesn't get kind of too robust or too heavy in the weightings and whatnot. Keep an eye on that as we get into year end, because I think that's going to be really important into 2025. We've had both equities and fixed income moving kind of in the same direction for a little bit of while here. And I think what we're going to start to see is that probably starts to look more heavily on way more heavily on equities going forward, that for them to do the heavy lifting and keep up with fixed income, the economy is going to have to be stronger than what it's showing right now.
Bill, is there anything you would add to that?
Yeah, I mean, I'll put some weight on what Shawn said, which is, this is, in my opinion, this is not the time to engage in a FOMO activity. right? Fear of missing out. That phrase was coined a while ago. It is time to maintain discipline. We're going to increasingly talk about how the higher markets go, the higher risk levels are. Risk elevates its markets go higher. It's foolish to think that there is, in my opinion, and I've spoke to this on our prior installments, I think there is a technology shift going on with artificial intelligence. It's really hard to figure out where you are in that cycle and how it plays out. But it's also foolish, just like the dot-com era, to think that they can't go backwards. Just look 3 years ago. Large cap growth stocks sold off, quite heavily 3 years ago. So discipline, maintain risk profile, look to things that are perhaps, I would say, I don't like to use the word opportunistic, but, Shawn had mentioned fixed income. It is particular to a person's risk profile, but I'm extraordinarily bullish on fixed income. I think we're addressing fixed income in a very thoughtful way, and I'm very positive on how I can't wait to see the outcome of how this plays out for us and our clients in the next 18 months. We've been active in that market for years, and I feel like this is one of those opportunities that's really speaking right now. So the fixed income market on a risk return basis it's screaming at me right now.
Yeah, and it tells me that we've got a lot more discussion in future sessions to come about what the impacts really are. So for the sake of time, I want to thank you guys. I really appreciate the insights. I think they're extremely valuable for all of us. Just want to, again, thanks for your participation in this, and I'm looking forward to future sessions.
Thanks, Jim. Appreciate it. Thanks, everyone.
See you.